The world just changed. While everyone was focused on inflation numbers and stock market highs, a quiet earthquake hit the very bedrock of the global financial system. The earthquake started in Tokyo. For decades, Japan served as the world's ultimate source of cheap money. Its interest rates were zero, even negative. Its currency was deliberately weak. This was not an accident. It was the fuel for a global carry trade that powered everything from U.S. tech stocks to emerging market debt. That era is now over. The Bank of Japan, after years of fighting the market, has let go. It has stopped its massive bond buying program. It has allowed yields to rise. A 10-year Japanese government bond now yields over 2%. A 40-year bond yields over 4%. To an American observer, these numbers seem small, but in Japan, this is a revolution. It is the equivalent of a kill switch being flipped on the global economy's invisible engine. This is not just a Japanese story. This is a story about liquidity, the lifeblood of markets being systematically drained from the entire world. When the source of the cheapest money on earth dries up, every asset, everywhere, must reprice. The consequences are slow, deliberate, and inevitable. This is the story of how that happens. Let's understand the official action. For over 20 years, Japan has been an economic anomaly. It battled deflation, a shrinking population, and stagnant growth with one radical tool: yield curve control. The Bank of Japan promised to buy unlimited amounts of Japanese government bonds to keep the 10-year yield at 0%. They printed yen to do this. This created a permanent artificial market. It was a policy of pure financial suppression. The goal was to make borrowing free for the Japanese government, which carries a debt load far larger than any other developed nation. It also made the yen the go-to funding currency for the world. If you were a hedge fund in New York or a bank in London and you wanted to make a big bet, you would borrow yen at almost zero cost, convert it to dollars, and buy higher-yielding assets. This trade was the hidden foundation of market liquidity for a generation. The Bank of Japan just ended that. They have stepped back from their unlimited buying promise. They have let the market set the price. This matters because it is a confession. It is Japan admitting it can no longer control both its bond market and its currency. A collapsing yen made imports, energy, and food unbearably expensive for its citizens. They chose to protect the currency. In doing so, they unleashed a force they spent decades containing: the real price of money. Now, the yield on Japanese debt is set by global investors, not by a central bank decree. And that real price is rising. This shift is seismic. It changes the fundamental calculus for every major financial institution on the planet. The anchor of global interest rates, which was bolted to the floor in Tokyo, has been pulled up. Now the entire ship is adrift, and the waves are just beginning to form. Now, we must contrast the paper market with the physical world. In finance, there are two parallel realities. One is the world of paper claims, the bonds, the ETFs, the futures contracts. The other is the world of physical things, the bars of metal in a vault, the barrels of oil in a tank, the goods on a shelf. For years, the paper market has been dominant. It is bigger, faster, and driven by leverage and promises. The rise of Japanese yields is a paper market event. It changes the value of promises. When the yield on a risk-free Japanese bond rises, the math for every other paper asset shifts. Why own a risky corporate bond if you can get a safer yield at home in Japan? Why borrow yen to buy a speculative stock if the cost of that borrowing is no longer near zero? The paper market reacts to these changes instantly. Prices flicker on screens, algorithms trade, but the physical world moves slowly. It is constrained by inventory, by supply chains, by real labor and real resources. This divergence is where immense pressure builds. Consider the market for U.S. Treasury bonds, which is the largest paper market on earth. Japanese institutions are some of the biggest foreign holders. As yields rise in Japan, the incentive to send money overseas weakens. Demand for U.S. treasuries could fall. This is a paper market dynamic. Yet the U.S. government's need to finance its debt is a physical reality. It needs real buyers for its bonds. If the paper market demand falters, the physical need does not disappear. It creates a void. This void must be filled either by much higher yields to attract new buyers, or by the Federal Reserve printing new money to buy the bonds itself. That act of printing is the moment the paper world invades the physical world, diluting the value of currency and lifting the price of tangible things. This is the pipeline through which a shift in Japanese bond yields eventually affects the price of everything you buy. Let's examine the vault, the supply side. In the world of hard assets, data is everything. It is about visible inventory, reported withdrawals, and measurable scarcity. For years, the narrative in paper markets has been that of abundance. There is always another bond to issue, another share to float, another digital token to create. But in the vault, the story is different. Take the London Bullion Market Association vaults, which hold gold and silver for the global financial system. For months, reported inventories have been declining. Registered silver, the category of metal available to settle futures contracts, has seen dramatic drops. This is not opinion. It is a published number. When you see the inventory in the vault fall, it tells you one thing. Physical demand is outstripping the readily available supply. This can exist alongside a falling or stagnant paper price for the metal. Why? Because the paper price is set by futures contracts, which are leveraged financial instruments often traded by entities with no intention of ever taking delivery of the metal. They are trading a promise. But the vault data shows what is happening to the real thing. When promises are strained, people start to ask for the real thing. They ask for delivery. And the system is only designed for a small fraction of paper claims to ever be settled physically. The vault data is the canary in the coal mine. It shows a quiet, persistent drain of the physical asset from the heart of the financial system. It is a signal that some participants are opting out of the paper promise and moving into the tangible object. This behavior accelerates when trust in the paper system erodes. When the anchor of Japanese stability lifts, trust erodes. The motives of the large banks and institutions are complex, but they follow a clear logic of survival and profit. They are not villains in a story. They are entities navigating a system of rules and incentives. Their primary motive is capital preservation. When the foundational price of money changes, their entire portfolio is at risk. A Japanese pension fund, for instance, holds massive amounts of Japanese government bonds. As yields rise, the market value of those bonds falls. This creates a hole in their balance sheet. They are required to maintain certain capital ratios. To patch that hole, they must raise cash. The easiest way to raise cash is to sell assets that are liquid and have gains. Often those are foreign assets, like U.S. technology stocks. This is not a conspiratorial sell-off. It is a mechanical forced rebalancing. It is an institution responding rationally to a change in its home market. Similarly, global banks engaged in the yen carry trade now face a rising cost of funding. Their profitable trade is becoming unprofitable. They must unwind it. Unwinding means selling the assets they bought with borrowed yen and repaying the loan. This creates selling pressure in a wide array of markets simultaneously. The motive is not to crash markets. The motive is to reduce risk and avoid losses. But when every major institution is doing the same thing at the same time, the effect is a tidal wave of selling. Their actions are neutral and factual. They are following the new rules of the game. The problem is that the rules have changed and the game is now much more dangerous. Now, we must speak to the psychology of the retail investor with empathy. If you are watching this, you likely have a retirement account, a portfolio of stocks and bonds, or savings you hope will grow. You have been conditioned by a market that has, for most of your investing life, gone up. Dips were bought. Crises were met with central bank rescues. This created a powerful belief. The system will not be allowed to fail. This psychology is now the greatest risk you face. The feeling that this time is different is always met with skepticism, and for good reason. But what if the tool used to make things not different is broken? That tool was limitless, cheap liquidity from Japan. If that source is being removed, the old playbook may not work. Your psychology is set to buy the dip. But in a regime of draining liquidity, a dip is not an opportunity. It is a warning. A slow, grinding decline can be more damaging to psychology than a sharp crash. A crash is clear. It forces a decision. A slow bleed creates doubt, hope, and eventual exhaustion. You will hold on, waiting for the rebound that always came before, until one day you realize you have lost too much to recover. This is the trap. The institutions are selling into strength methodically. They are not emotional. They are executing a plan. The retail investor, watching the news and seeing a company with good earnings, buys the small rally, only to see it fade a week later. This happens again and again. Confidence turns to confusion, then to despair. The greatest danger is not being wrong. It is staying wrong for too long because the new environment does not look like the old crisis. It just looks like a bad market. And in a bad market, the instinct is to wait it out. But if the fundamental liquidity tide is going out, waiting is the riskiest move of all. We arrive at a scenario-based conclusion with no advice, only observation. Imagine a path where Japanese yields continue to drift higher. The yen strengthens as capital flows home. Japanese institutions continue their methodical sell-off of foreign assets. This selling acts as a constant headwind on U.S. equity markets. Rallies are shallow and short-lived. Meanwhile, the reduced Japanese demand for U.S. treasuries forces the U.S. government to offer higher yields. Mortgage rates climb. Corporate debt refinancing becomes painful. Something breaks in the financial system, perhaps a regional bank or a highly leveraged fund. The Federal Reserve is faced with a choice: let the break happen or intervene. History suggests they will intervene. They will announce a new program of bond buying to stabilize the market. They will print dollars. In that moment, the narrative shifts from interest rate risk to currency debasement risk. The paper market, terrified of holding a depreciating currency, scrambles for real assets. The price of physical things, energy, minerals, agricultural land, and yes, precious metals, begins to disconnect from its paper derivative. The vault inventories drain faster. The disconnect between the two worlds, paper and physical, becomes a chasm. This is one scenario. Another scenario is a more controlled, prolonged grind. Japan manages to slow the rise in yields, but the direction remains upward. Global liquidity slowly evaporates over years. Growth stagnates. Assets slowly reprice lower in real terms. It is a silent transfer of wealth from those holding financial assets to those holding essential, scarce resources. In both scenarios, the constant is the end of the era of free money from Japan. The kill switch has been hit, the machine is powering down. The only question is how long the lights stay on and what you can see in the dimming glow. The prudent observer watches the flows, respects the data, and understands that the most powerful moves in markets begin not with a shout, but with a whisper from a place nobody is watching. That whisper is now coming from Tokyo. It is a tremor in the data, a subtle, persistent shift in the lines on a chart that most will scroll past. But in finance, the quiet numbers are the ones that break empires. We've seen the official action, the crack in the control. We've seen the divide between the world of paper promises and physical things. We've seen the vaults quietly emptying and the mechanical, unfeeling motives of institutions preserving capital. We've felt the psychological trap being set for the unprepared. Now we must follow this tremor to its logical end, to see the architecture of what comes next. This is about connections. The wire that runs from a government bond auction in Tokyo to the price of bread on your table. It is long, it is complex, but it is real, and it is tightening. Consider the chain. It begins with a single Japanese government bond, sold at auction with a yield that is no longer pinned to zero. A domestic insurance company buys it. To allocate this new capital, it must rebalance its massive portfolio. It decides to sell a portion of its holdings in a U.S. stock index fund. That sale is executed by a bank in New York. The bank's trading desk absorbs the sell order. To hedge its own risk from holding that equity, it might sell S&P 500 futures contracts. Those futures are bought by a high-frequency trading fund, which immediately sells them to another party. The price pressure from the original distant decision in Tokyo filters into the market. It is a single drop in a vast ocean, but the auctions are weekly. The rebalancing is continuous. The drops become a drizzle, then a rain. Across the Pacific, a U.S. corporate treasurer watches the yield on 10-year treasuries rise because one major class of foreign buyer is stepping back. She decides to delay a bond issuance to fund a new factory. The factory is not built. The jobs it would have created are not offered. The economic activity it would have generated simply vanishes from the future. This is how liquidity drains, not with a bank run, but with 1,000 delayed decisions, 1,000 scaled-back plans, 1,000 sales made not out of fear, but out of procedural necessity. The physical world feels this drain as a slow pressure. When financing becomes more expensive or uncertain, the entire supply chain seizes up just a little. Less capital expenditure means less investment in production. Less production over time means less stuff. In a world already attuned to shortages, from microchips to agricultural inputs, this incremental tightening is the difference between scarcity and crisis. The paper market might be selling off stocks, but the physical market is bidding up the price of copper, of lithium, of wheat. Because the real things are needed regardless of the financial weather. This divergence creates a peculiar and dangerous moment. Financial deflation in asset prices coupled with persistent inflation in the cost of living. Stagflation is the clinical term. A squeeze is the human one. This is the environment that central banks fear most because their tools are blunt and contradictory. Raising rates to fight inflation crushes the leveraged financial system. Lowering rates to support assets fuels the inflationary fire. They are trapped, and Japan's move has just tightened the walls of that trap. Now, look deeper into the vault, not just at the inventory numbers, but at the behavior they reveal. When an entity takes physical delivery of metal from an exchange vault, it pays a premium. It accepts storage costs, it forgoes liquidity. This is an irrational act in a world of perfect, efficient paper markets. It is done for one of two reasons: desperate need for the raw material for industrial use, or deep distrust in the paper counterparty system. The steady drain suggests both are at play. Industrial users, seeing future scarcity, build inventory. But the other participants are financial. They are exchanging a digital claim, a futures contract, for a heavy, inert bar. They are opting out of the financial network and into the tangible world. This is a silent vote of no confidence. It is not a loud protest. It is a withdrawal. It is capital leaving the system of promises for the system of things. Every bar that leaves the registered category of the COMEX or the LBMA is a small reduction in the buffer that allows the paper market to function smoothly. The smaller that buffer, the more volatile the paper price becomes to any shock. The system becomes brittle, and the tremor from Japan is a shock of sustained, unrelenting pressure. For the banks and institutions navigating this, the calculus is now about collateral. The modern financial system is a labyrinth of loans, all secured by collateral. The highest form of collateral has always been sovereign debt, like U.S. treasuries or Japanese government bonds. When the market value of that collateral falls, the labyrinth trembles. Loans that were once safely over-collateralized are now under pressure. Margin calls are made. To meet them, institutions must sell other assets. Any assets that are liquid. This is the dreaded liquidity cascade. It is not about the quality of the asset being sold, it is about its sellability. So, in a single portfolio, a falling Japanese bond price can trigger the sale of a perfectly healthy Australian mining stock or a German corporate bond. The contagion is not fundamental, it is mechanical. It is a fire alarm ringing in a crowded theater, causing a stampede where people are hurt, not by the fire but by the panic. The institutions are not panicking. They are following cold, automated rules, but the effect is the same. Their motive is survival within the rules of the game. The problem is that the game's central premise, that sovereign bond prices are stable, is now in question. Retail investor psychology is not built for this environment. It is built for narratives, for stories about innovative companies and growing earnings. It is not built for stories about collateral chains and repo market stress. So, the individual investor will be left searching for a familiar narrative to explain the unfamiliar market behavior. They will latch onto earnings reports or product announcements. They will see a good quarterly report from a company and buy, believing the story is intact. And for a day or a week, they may be right. But underneath, the mechanical selling from rebalancing and deleveraging continues like a slow tide, pulling the price back down. The investor is confused. They blame manipulation or algorithms. They dig in, believing their research is superior. This is the grinding process that exhausts capital and conviction. The investor's greatest strength, long-term conviction, becomes their greatest weakness, because the regime has shifted. The rules of the past no longer apply. The buy-and-hold investor of the last 20 years was riding a tidal wave of global liquidity expansion. They are now facing a tidal wave of liquidity contraction. Holding on through that requires a different kind of fortitude and a different kind of portfolio, one anchored in realities, not narratives. The task for the observer, then, is not prediction. It is perception. To watch the right signals. The yield on the Japanese 40-year bond, the weekly change in holdings of U.S. treasuries by Japanese custodial accounts, the inventory levels in the LBMA vaults, the bid-to-cover ratios at U.S. Treasury auctions. These are the vital signs. The headlines will talk about earnings, politics, and geopolitics. Those are the symptoms. The vital signs show the health of the system itself, and right now they are indicating a patient entering a new and stressful phase. The treatment, more liquidity from other central banks, is known, but every treatment has a side effect. The side effect is the devaluation of trust itself, the slow migration of value from the digital ledger to the physical object. This is not an investment thesis, it is a historical process. It has happened before when systems of promise become too heavy for their foundations. The foundations are shaking. The tremor began in Japan. It is now traveling through the veins of the global economy, seeking the weakest points. To be aware is not to panic, it is to be awake. And in a world that is slowly changing its fundamental rules, to be awake is the only position that matters. The quiet number has been called. The game continues, but the stakes have just been raised.